Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing show. I'm Victor McClure.
And I'm Guy Allard.
Oh, my gosh. I'm trying to get over last week's Cowboy game. No.
I heard that powerhouse Seattle took him to school.
You know, the 29th ranked offense, they apparently couldn't stop it.
Well, you can't blame the Cowboys. They got that Carroll coach up there who's awesome.
Yeah, I can't stand him.
That's why I said he's awesome.
Hippie, he's wanting people to kneel. Hippie kneeler.
I talked to somebody on the phone that came in and worked with you 3 or 4 years ago. And he goes, yeah, I talked to Victor McClure. I said, well, I'm Guy Allard. I do the, oh, you're not the one that has that funny laugh, are you? That, you know, like, oh, and he caught himself. He didn't say what he really wanted to say. Like, oh, brother, here we go.
You're like, no.
No, that wasn't me.
So a lot going on this week. The Fed raised rates.
It's 3.1 now.
Fed funds rate. Remember that thing was 0 a few years ago, right?
Yeah.
So they're going to remember everything is based on that Fed funds rate. You might have a loans based on prime rate, but the prime rate's based on the Fed funds. Everything goes down to that core. Every bank account, everything. You know, I haven't seen the banks raise money markets up to 3%.
No, they haven't been commensurate. You know, the funny thing is about the Fed, they've been talking about wanting to have inflation at 2%. Well, everything I've read, it's there. It's been there for a while.
Yeah.
So, you know, why do you raise the rate? So, but they did, and it was unanimous, right? It was on Wednesday, and now they're talking neutral for the rest of the year. But
3 months left in this year.
Well, another quarter. Yeah. But then, you know, next year they're talking about it, doing it a couple more times. But if their target is 2 and we're at 2,
yeah, why do you keep messing with it?
You know, yeah.
Well,
just saying.
They know more than we do, I'm sure. Who knows? I think
well, now wait a second. I take exception to that.
Like I said, everything like that costs you money, in other words, you're borrowing from a bank, goes up with these interest rates. I just looked at before this rate increase early in the week, and I think a 30-year mortgage is up to like 4.5, 4.75. Remember that was down to like what 3.2, something like that. So that's come up. So trust me, they'll go up again now that they've raised the Fed funds rate. So that's based on it goes lockstep. My savings account over there, by the way, is not going lockstep. It's still at like 0.1% or 0.01%.
Have you ever seen such a large discrepancy between what the rate is or what you're getting in interest compared to what credit cards are charging if you carry a balance? I've never seen it as bad as it is right now.
It's pretty bad. Well, they can go up to, it's one of those things that, let's say you went to the Bahamas and you were in a little longer vacation than normal, and you missed one payment on a credit card. You always pay it, just one payment.
Yep.
Well, they got a default feature that charges like 28% now. You're locked into 28%. And all your other credit cards can latch on to that high rate.
Oh, yeah.
I mean, they have their own default thing. They say, oh, no, it says here, if you ever miss a payment or a payment on another credit card, we can do it. So maybe you're doing bills, you're on the way out the door, you missed one. All of them can raise your rates to the ridiculous amount, 30%.
That's to stick it to the client. That's kind of like when you're at Discount Tire and they bring out that thread gauge. You know you're going to get in trouble. Oh, no, you don't have enough thread. Tread.
Tread, that's right. So that's why, you know, banks are on my axis of evil list.
Then they should be.
They should, because I would think if Fed funds rates are 3.1, they'd be giving, 2.5 on a money market, 2 anyway, right?
Think about all them farmers that lost their farms. That's right.
Oh, that just bugged me. CDs have come up the last a while, but CDs are only like 2. I remember I saw this giant sign. I walked in a bank. I won't say which one. It's a bank I use. But this was a year or so ago. This big old sign they had printed up. So it cost them several $100 to print this sign. And it said, we are proud to announce a 1.2% 5-year CD.
They were proud of
that. I
was
like, whoa. 5-year CD at 1.2.
And if you're listening and wondering, there are some good MYGAs, which is a multi-year guarantee annuity, which is similar to a CD, 5 years. If you do the right thing, you can get about 4% right now. That's the top. That's a very, very top. And you got to make, but you have better access. You've got creditor, you got a lot of things that go with
and
it.
Those
so.
might come up a little bit in the next couple of weeks. I'll just give you that.
Yeah,
they don't go lockstep with things, but sometimes they will. So you might want to check back a couple weeks. Might be good at 4.25.
That's right.
4.5, which is not bad on.
That's getting tempting, right? With the stock market average for the last 17 years.
Oh yeah.
4.97. That's right.
So it's not bad.
No.
I was just thinking of, remember my axis of evil. One is the banks. Others airlines. After I sat through an 8 hours, a couple of Fridays ago, an 8 hour delay.
Yeah.
I get on the plane, sit on there at midnight, and they said, your pilot's finally here. They're moving from another plane. We're sitting there. I've got all country. I start watching one of the movies on there, right? And they come up. Pilots called a timeout. The crew's called a timeout. I go, what the hell does that mean? Everybody off the plane, flight's canceled.
They reached their limit time-wise?
I guess. I don't know what it was.
Well, you think they would have known that when they were...
Yeah. I was tired because I got in the airport at 2 o'clock in the afternoon and was on the plane finally at midnight. And then as we're leaving, they said, oh, by the way, we're not going to charge you a change fee to change this flight. I'm like, oh, really? You're not going to charge me to kick me off in here all night?
You did get out of town the next day, right?
Well, they said the next day. Put it on there, and it was supposed to be 4:30. I left at 10:30 at night, finally.
That's brutal.
So I was supposed to help move my mother into assisted living or whatever. And instead of 3 days, 4 days, I had like 1.5. So. But
at least in Vegas, it was unnormally cool.
Yeah, 108 degrees.
That's right.
It was nice. And that's what I'm thinking about.
Unusually cool.
I'm like, so they're stuck in the middle of my axis of evil still. You know, one of them said, well, we're going to, if you buy this credit card, you get an extra bag fee. I'm like, this bag fee, you know how much it makes them? Billions of dollars.
It's crazy,
this
right?
Bag fee they made up. Made up crappy bag fee.
I heard just last week, and you hate like heck to have the government involved in anything, but they're going to start regulating the leg room and the seat size and a few things. At least they're in the talking stage of it. I hate to see them involved, but man.
Well, it is getting bad.
Yeah.
Like I said, I was sitting back there one time, and I'm 5'10". You know, I'm not some giant 6'8" guy. My knees are almost touching the seat in front of me. Everybody else is really tall. They're kind of on the outside of the seats, getting hit their knee with a cart. Like, oh man, people bumping into them all the time, right?
That's right.
And then the guy leans back in front of you, so it's about 6 inches from your nose, and I can't blame them. Of course, they want to relax. They paid for this flight, right? But I'm claustrophobic anyway, so it is just misery.
Remember back in the 80s when you could smoke the back half of the plane? You got this cylinder just full of smoke. Like the smoking area in the back is going to protect the people in the front from this cloud.
Yeah, people aren't old enough. A lot of people aren't old enough to realize they used to smoke on planes. Everywhere they smoke.
Oh, yeah.
My dad's office, you better have a guest ashtray. And if you don't want to be a jerk, you have to have that cleaned every new customer.
That's right.
So they got it, and everybody just smoking. They started drinking about 3 o'clock.
That's right. Martini lunches.
Yeah,
that's right.
That's the old 70s, right? 60s and 70s. Those businessmen had a deal going.
So rates are coming up. Trump was at, everyone was at, but from our standpoint, Trump was at the UN and talking about our international policies, and we've got trade stuff going on with China, which has everyone a little bit unnerved. I've heard some people, even read an article from Kissinger, which he's in his early 90s now, talking about Kissinger went on to say how he really liked the current policies and that no one else would be honest and stand up and all that stuff. So hopefully...
he was Nixon's guy?
Yeah.
Dr. Henry Kissinger, right?
Who was it? Mao Zedong, wasn't it him? Yeah. He did the deal over in China. Yeah.
So I can't believe he's still alive.
That was a long time ago. I know, it's like 94
I actually saw him
in
in an interview, and he didn't look that bad.
No, the picture I saw, if it was current, which you never know.
If I lived in 90-something, trust me, I won't look like that.
Oh, you might.
Yeah, right.
Anyway, so lots of things going on this week.
So what we're going to do is we're going to talk about a couple case studies. These are real people came to our office.
Names are changed to protect the innocent.
We're not going to mention names or anything else. Nothing specific.
May give out a phone number.
But we can show. We're going to show you how. Remember, our retirement analyzer software is the most comprehensive retirement software I've ever found. You can actually take inflation of individual expenses when most of them it's just a blanket thing. The reason that's important is, a loaf of bread does not go up with inflation. Otherwise, it'd be $200 a loaf right now. Carton of eggs, $200 a carton. They don't. But
conversely, medical expenses go up much faster than
7% a year, 400% in the last 20 years. So you got to be able to account for those kind of things. And anybody tells you your water bill is going to somehow go down over the next, they're going to charge you less per gallon of water or less per kilowatt of electricity, you are on dope.
Perfect.
You need to stop whatever you're doing.
Example, I was going through the basics with a guy getting ready to put him into the retirement analyzer today on the phone, and he was talking about his rental properties. He was so happy and proud that they're paid off now, and then he thought for a second, he paused, he goes, but you know, it doesn't make a difference that much because my insurance and taxes are more than what I was paying for monthly. We talked about that, I thought that was funny. We
got a break coming up, folks. We're going to have a great couple of case studies here. Stay with us. Remember, if you have any questions, call us at 972-715-2424. You can call our toll-free number, 1-800-McClure. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome to the Common Sense Investing Show. Before the break, we were talking about a couple case studies. Remember, I have the largest concentration of my clients are engineers, probably the next are doctors. The main reason is I'm a numbers guy probably, and I run numbers, lots of numbers. I love lots of spreadsheets, and a lot of the average people don't like that at all. You give them 15 spreadsheets, they're not that happy. But like I said, engineers, I give them 3-4 spreadsheets. They'll correct some of our stuff, you know. So here's the first one. We had a client coming in. It's like I said, I'm not going to tell you which one's which. You can guess yourself. You can play a game with 7 which. This is a single person, not married, so he must have saved a lot of money, right?
And has low expenses, I'm thinking.
I'm a little jealous on that front, but no. 63 single, was going to retire at 66, I believe. Let me see. I can't remember what year he's retiring now.
So 3 years to defer.
Yep, let's see here. Yep, going to retire at 66. So we ran these numbers. First, you got to gather, what's their birth date and all that kind of stuff. You got to have life insurance. Then we go over their Social Security. Here's your Social Security, what you're going to get. All right.
And by the way, if I could add, if you don't know, they used to print pamphlets, and you'd get them quarterly or a couple times a year. They've quit that pretty much. Every now and again, one will show up at you to save money.
Right.
So if you don't know and you want to know, go to ssa.gov. If you haven't set up an account, and you can go there and check on that at any time.
Right. There's a confirmation, like to confirm who you are kind of thing.
Yep.
Sometimes that gets a little tricky, but you should be able to get through it. But all right, this person was supposed to get about $2,500 in Social Security a month. Also had a pension, a small pension of $1,000 a month. Every time I say pension, it's like me talking about a dinosaur trying to
you do fewer and fewer.
I want one, right?
Yeah, absolutely.
But then we show, there's cost of living adjustments on Social Security, right? So we gave them the history. Since 1975, Social Security, the average increase per year has been 3.71% a year. That's pretty good, right?
That'd be real good.
The only issue is the last 10 years has been 1.64%.
That's what the program defaults
to.
That's right.
Actually, when I'm looking at the chart here, and we'll show you every single year since 1975, it only hit one time at 5% since 1984.
Wow.
It was all in the 80s when they did that. Okay, so that's the power of, remember in 1980 you had like a 15% CD. But since the government did not have this really protectionist kind of policy, they always thought, hey, inflation's good. It's going to cool down an overheated economy, all that, so they let it run. But ever since then, like around 81, 82, you have not seen anything go up like that. If it does, just like the Fed's doing now, raising interest, they'll beat them down 15, 20 times to make sure that the inflation doesn't get crazy. So you're not going to get that kind of big run.
No,
anymore.
And a real good example, even through those years when you had the bigger, I certainly saw my parents, my stepfather, who retired late in life, and you look at them now, if you've taken care of your parents and you've handled the Social Security for them and you see it, it's not much. Even the ones that have been on it for like 15 years, you think it would give me like $4,000 now a month. No, it's not. It's like $1,500. It's because they started earlier, and it was much less when they started.
1.64% increase the last 10 years. It's not reasonable to assume it's going to stay the lowest in 10 years either.
I don't know.
So I would say it'd be close. I'd stay close, maybe
Right.
2%. Okay, so we use a number something like that, like a 2%, because you got to account for some kind of increases. Otherwise, you're not being fair to Social Security. But that doesn't sound right. Being fair to Social Security,
Especially when they're going to run out of money.
This particular client had about 1.3 million. Now remember, everything we're doing here, whether you have 25 million, 250 million, or 400,000, they all work percentage-wise. It really doesn't matter. We can make numbers work that really, it's almost like magic. Some clients come in, there's no way that can be. Well, here it is. I had one just this week. That is impossible. Look the numbers and numbers. He goes, wow, that is a good deal.
Now, that's assuming the person with a $400,000 net worth has bills commensurate with that and not with $20 million.
Right.
So
this person basically had about 80-something% in stocks and bonds. Between like 6-7 different, mutual fund company with one, a brokerage account, a 401k, stuff like that. He was here it is. He's actually at 90.03% stocks. Now, the one thing people get confused right now is that if they've got a stock and bond portfolio, let's say they got a 60-40 or 70-30 portfolio. Well, forever, the bonds hedge the stocks. So stocks are going down, your bonds are okay, right? But stocks have gone up 9 years in a row. Interest rates are going up on bonds. They're losing their butt here the last year or so.
Absolutely.
So now, wait a minute, I got a double anchor going. So even if I had now don't get me wrong, if you got a decent bond portfolio, it's not going to go down as much as stocks, but it could still go down 25% if interest rates go up enough. So you got a double anchor. And that's why Roger Ibbotson, the Yale professor, says you got to do something else besides bonds for your safe piece. That's a side note kind of thing.
And if I keep interrupting, but if I can add, we've got some white paper from Ibbotson and from Schiller that shows the difference between having bonds in your portfolio as a hedge or having fixed annuities in your portfolio as a hedge, and the combination thereof. And if you have any questions or if you want to take a look at that, call us, 972
715
2424.
2424. 972-715-2424. And you can use anything. You can use a CD.
Sure.
Anything that is not interest rate sensitive. The problem is just the fixed annuities, they work better.
They pay more right now.
Anything besides a bond.
Yeah.
And the longer the bond, the worse the bond. The higher yield the bond, the worse the bond. You got to be really careful. We got a break coming up. We'll continue this one case study when we return. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Before the break, or last segment, we were talking about a case study of a 63-year-old client that came in, or just say person that came in.
Retiring at 66.
That's right, retiring at 66. They were getting about $2,500 at Social Security, okay, and had another $1,000 a month in pension. We talked about the Social Security cost of living adjustments, what we're going to use as an average. Used to be about 2.5%, but we had to lower it. In the last few years, they changed the way they calculate the cost of living. They took out one of the main parts of inflation, which is energy.
They're moving the target.
So, your gas price, your electric bill, they took that one out.
They control the Consumer Price Index, if you didn't know, CPI.
So somebody told me, well, why would they do that? I go, so they can screw us. That's why they would do it. What do you think? They won't have to pay as much.
That's right. That's like some of these municipalities that talk about lowering their crime. Well, they just changed the criteria for what's considered a felony and what's not. Crime hasn't lowered. Anyway, I digress.
Person has about $1.3 million, okay? They're about 90% stocks at this point. Now, what does the Rule of 100 say that a 63-year-old should be? Well, it's actually 63% safe instead of 10% safe. Can you go off of that a little bit? Sure. But you can't go when it says you're supposed to be 63% safe and you have 10% safe. Now, it might work for you, especially the last 9 years the market hasn't gone down. But at long term, it will fail. It will always fail.
But, man, I tell you, just briefly, it is hard to get people to change. Now, we see them all over the board, but wherever you are, right, it's your comfort zone. And you pretty much have blinders on. We've talked to a lot of people that are 100% in cash. Oh. And they don't want to do it. They don't want to do anything. I mean, it's cash. They don't want to do anything.
Liquidity is great. It's important.
Oh, I don't want to tie it up. That's right. That's right.
It's just like taking a risk. Cost you. If you're wrong or you didn't have it allocated right, you're going to take the brunt of it, right?
And then you got the other guys that have 60, 70, 80, 90, 100% in the stocks. Right. And it's hard. You can show them, and that's why we do well with engineers. You show these guys black and white, the difference and how it enhances the return and the guaranteed. Nope. Stock market's the way to go. Okay.
And I love the stock market. We love it. We don't tell anybody to get out of the stock market.
I love liquidity too, but you don't do 100% of either.
All right, so they should have been more 60-40 portfolios, 60% on the safe side because of their age. Now, the only time that's ever been adjusted is in the 90s, so they went up to 110, 120. But if you look for the source of the person said 110, in other words, you can have another 10, 20%. The source of it was a mutual fund company.
Yep.
So they didn't change the rule of 100s. They just mutual fund companies sell more mutual funds, so you can have more.
Which came from the College of Financial Planning, not a broker.
All right. Projected rates of return. Here's where we can make some adjustments. The ideal retirement plan projects a 0 return. Why? Because you want your retirement plan based on, you don't want your retirement plan based on what the market will or won't make. In other words, if the market doesn't cooperate, are you eating cat food now when you're 80? That's what you have to ask yourself. And so you want to use that. But you can use a couple percent if you want. You just got to remember, it's a stress test. I've got so many people said, no, I took it to my broker, and they said, if I just make an average market 10% a year, I'll be fine. I go, why did you even go through all this? I could have told you right now with a couple $1 million, if you make 10% a year, you're going to be fine. I go, but that's not it. That doesn't tell you anything. Market's made half of that.
We talked about it a little bit last week on the show. The market's gone down 15% or more 16 times in the last 60 years. What's the odds that it's gone down once or twice in individuals' retirements?
30, 40-year retirement.
Yeah, huge.
All right, so that's what you got to do. You put one number, like, remember, markets are average 4.97. Average investors made 2.5. So if you're counting on this average market of 10, the people actually receive 75% less than that number. So those aren't plans. Those are not plans. They're just wishes. This is a wish list.
It's a hope.
This is a retirement plan. Now, what happens if you project a couple percent return? You know, I can see a 50-50 portfolio. Maybe your stock's making 4 and your money market's making nothing, or whatever. But what if it actually, you do make 7 or 8? Well, that's extra for you.
That's a high-class problem.
Yeah, you want the plan to be based on a lower worst-case scenario, because if it's on a worst-case scenario, when you have an average or above-average scenario, you're going to be really happy.
That's right.
You don't want it where you base it on an average, above-average, and then all of a sudden it doesn't cooperate. Now you have to go back to work trying to knock on doors at 85 years.
And it's too much of a gamble. The pain would be too high if it doesn't work.
This 63-year-old single person had about $5,000 a month in expenses. Remember, we raised them 2.5% to account for inflation. So it was around $5,400 or something when they retired.
3 years later.
All right. Then that's when you go over historical inflation. 3.14 has been the inflation rate for the last 100 years. It's been 1.68 the last 10 years. So we're going to use 2.5 on that one. Okay. I can tell you why if I had a little more time. But then our program will show you all the tax rates. You know, one of the most impressive things I've ever seen when they passed the last tax deal?
Yeah.
Within 48 hours, our software was updated.
Yeah, that's right.
This will tell you exactly the taxes that are coming out of your account. The only thing it can't account for, if you got a big loss carry forward, a bunch of depreciation, it can't account for that. But it's very comprehensive. Remember, if you have any financial questions, if you'd like to take advantage of our no-cost, no-obligation retirement plan, our number 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back. Remember, today we're doing a case study. I don't think I'm going to get through 2 of them, but one's a doctor, one's an engineer. This particular one, 63-year-old retiring at 66, saved about $1.3 million.
$3,500 a month in income from Social Security and pensions.
Right. And so basically we need about $1,500 a month. He had $5,000, but with inflation it was $5,500, so about $2,000 a month. Now it seems pretty logical to me that $2,000 a month you can get out of $1.3 million.
Right? $1.3 million.
The
no
only
problem,
issue
right?
is inflation, because your water bill and all that kind of stuff are going to go up. So pre-retirement obviously makes more than he spends, so he's saving money, right? What we did was, this actually person didn't do that bad. Made it to 93 years old before running out of money. Now, somebody might say, none of my family's ever made it to 93. But think about it. If you're 60 years old now, what has happened the last 30 years? The last 30 years, life expectancy has gone up like 17% or 30%.
And the longer we live, it increases our odds to live longer.
All right. So this one's pretty good. This person has more options. They don't really have to do anything. They got some real risk at 93, but 93 is a long way away, and a lot of people don't live that long. But his Social Security at that time, remember, it started out like $2,500. It's up to $3,500. It's up to $5,900 with inflation, right? The problem is his $5,000 in bills a month are also up to $10,700. So at that point, he'd have to lower his lifestyle by 50%.
And that's one thing I really want to impress on our listeners. That's what we run into with these all the time. Whatever age you run out of money, 75, 85, or in this case 93, which is a good run.
Right.
But when you're broke, your expenses are at least twice, maybe 3 times more than your income, and that's not workable.
You can actually reduce your expenses in your 80s, probably 10, 20% without that much of a hiccup. You're not reducing at 50 or 60 or 70. You're not going to. So you've got to look at these numbers. So we stress test this portfolio. It does run it, not because you can't take $24,000 a year out of $1.3 million, because you can do that. The problem is your expenses went from $5,000 to $10,000 a month. That's the issue that you've got. All right. So what we did was we took a portion of this person's money.
All right. We had $1.3 million total.
Yep.
How much did you take?
We took about $400,000. The total was like 30%.
About a third.
30%. We put it in an increasing income stream. Okay, increasing. So when it starts, it's going to be one number, and when it ends, it's going to be another.
Guaranteed not to run out ever. His
pre-retirement was the same. He makes a couple thousand more than he spends, right? But the difference is at 93, instead of being broke and having to reduce his lifestyle by 50%, he now has $814,000. Now, remember, he's living on this for 30 years. He had started with $1.3 million. So he's down to $800,000. That's not too bad over a 30-year lifespan. His expenses are now, same thing, $10,728, but his income is $12,290. Remember, before he just had that $5,000 or $6,000 from Social Security and pension. Now he's got an increasing income stream that started at $3,000 when he retired. It is now $7,500 a month. Now remember, he only put in $400,000. $400,000 that grows to $7,500 a month. That's $80,000. Almost $90,000 a year on $400,000. There's only a few. There's so many people that are doing similar stuff to what we're talking about. 90% of them are putting them in a level income. Increasing income. You've got to have everything keep up with inflation, or at least a shot at keeping up with inflation.
But think about it. Not only he was broke, and now he's got $800,000. He had half of what his bill requirements were, and now he's got $1,500 more a month. Now think about that $800,000 that's left over in the retirement savings account instead of being broke. He ran out at 93. 10 years before he hits 93, he sees where this trend is going, and you're holding on to a car much longer than you should. You're not getting the TV that you might have, and now you're at home a lot more than. So you're being very, very judicious and tight with your money. $800,000 left now in the retirement account. You're pretty much doing what you want to. If you're up for it, you still can take a trip. He's single. He could still be out on the Riviera with the women and the whole thing. It's a big difference in your lifestyle.
That's right. He has $1 million at 100. He only started with $1.3 million. He's lived on it for 40 years from there, right?
It took a third of his money home.
Just a third of it. And that's, like I said, one of the hardest things I have to convince people. It is the hardest thing I have to explain. We've been doing this 30 years. It is still the hardest thing. I'm going to take a piece of your money. I'm going to turn it into an increasing income stream. You will have more money because of it. They're like, wait a minute. You're going to take part of my money. I'm going to have more money. Yep. Every time you're going to have more money. It's not every time. It's probably 99% of the time, but it's up there.
Now, unless your expenses are absolutely crazy, we can do this for you. We do this all the time.
And the thing about it, even at not 93, that might be extreme because people. But the other one, he only had $400,000 at like 82.
Yeah, it gave him a lot of money.
He's got
younger.
like $900,000 at 82 in this. Either way, it's going to help you. Now, some people, we could do this, and they can keep the $1.3 million together.
Yep.
Depends on the expenses and how much time they have to defer. But we can keep. It's like the old days. Remember the old days? I'm gonna save $1 million. I'll be rich. That's what I thought. I make $100,000 a year. I'll be rich. That's what I thought. Because I'm gonna live on a 10-15% CD, right? $1 million bucks. Well, interest rates change that. Keeping the entire thing together, unless you have really low expenses and a lot of money, are very difficult. But with something like this, you could do that. We can show you strategies to keep most of the money together if you want to pass it to heirs, or even if you want the psychological aspect. Because remember, there's two parts of retirement. One of them is the mathematics, the financial aspect of retirement. Right. The other one's the psychological aspect of retirement.
Big deal.
I'll give you an example. Let's say you need $10,000 a month, and you're getting $5,000 from Social Security for you and your wife, right? When you take out $5,000 a month or $60,000 a year out of this retirement savings, and you see it going down every day, every month you see it going down. Now, sometimes it'll go up, market or whatever, but you see it going down. Psychologically, that will kill you. Now, what if you conversely, $10,000 a month in bills, and $12,000 goes in your bank account every month until you die, and that $12,000 continues to increase?
That's right. That's
the real retirement. Stay with us, folks. Remember, if you'd like to take advantage of our no-cost, no-obligation, the most comprehensive retirement plan I know, is 972-715-2424. Again, 972-715-2424. There's no cost or obligation. You can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Today we've been discussing an actual client that came in our office. We do not use names or whatever, but it really illustrates what you can do when you have an actual retirement plan, when you've stress tested a portfolio. And that's, in other words, this person's 63 years old, going to retire at 66. Now remember, it doesn't matter what they have numbers-wise. Whatever numbers you have, we will put those specific ones in there.
But your expenses do matter.
Your expenses do matter.
One point to pick out here, if you don't do this every day, and we do, and I get that you might not, to pick one of the points on this, he was 63, and he was retiring at 66. Time value of money and growing, right? Didn't have a whole lot of time for that money to defer and grow before he was going to start Now, it was only a third of the money, right, but for him to really get into that. Now, just think about it. If you're ahead of the curve and you're 50 or 55 or 63 but not going to retire to 70, you've got more time to let it accrue, and the numbers would be even better in those circumstances.
We basically used about 27% of his assets to create an increasing income stream. And what that did was, before, he's basically just going to spend the funds because he needs $2,000 or $3,000 a month out of the, beyond Social Security.
Doing that math in your head.
$3,000 a month, but the expenses are going up a couple percent a year. So his expenses that started with $5,000 are now $10,000 a month. And that's why it really accelerates. So I call it the slow death. What has happened is you start at $1.3 million, just taking out first is maybe $1,500 a month. Then after 10 years, it's $2,500 a month. Yeah. Then it's $4,000 a month. Then it's $5,000. And it really starts accelerating because your bills, even at 2% a year added to it, will double during most retirements, right? Something you didn't expect.
And as we get older, they kind of offset each other. You spend less money, right, because you maybe not be as active and dancing and taking trips and all that. But the assistance that you need more help around the house, someone to do the laundry, someone to do this, someone to do that, those expenses go up. So it keeps pace.
Right. So instead of them this particular person running out of money completely and having to reduce their lifestyle by 50% at 93, which is not bad. I could have showed you one that runs out at 71. Lots of them do. Retire at 65, run out at 71. We see it all the time.
Maybe we'll show them next week.
Right. So, but this person's saver. They save good money. They didn't make a fortune or anything. They save good money, and just need a couple thousand a month out of $1.3 million, and it still ran out at 93. Instead of that, we made it where their worst. If they live to 100, they're going to have 900 and something thousand left out of 1.3.
Well, I don't want to leave any money to the kids. I want the last dollar on the last day I'm here. Well, that's okay. What it's done is it's given you more money to do more things until then. You don't have to have 900 there. You can spend more.
Positive cash flow his entire retirement.
That's right.
That is important. Remember, the psychological aspect of retirement is when the paycheck stops and you see your account, that's your life savings going down every month because you got to take 5 or 10 grand a month out of this thing. It will psychologically wreck you. If the stock market goes down 10%, you're going to pull out of it. You're never going back in it because I don't have any paychecks anymore. I see where this is going. So it'll make you pull out of stocks when you maybe not should have. It will scare you to. Now, conversely, if you got $10,000 a month in bills and $12,000 is coming into your bank account every single month till you die, and it keeps increasing because your bills are increasing,
that's right,
and this payment keeps increasing, that's the kind of retirement you have. So I try to tell people all the time, I go, I've been doing this 31 years, right? We've been doing this over 30 years. And it's so hard to explain, but when people start losing money and they're spending their assets, forget the sequence of returns risk that, mathematically you're screwed.
That's right.
Forget all that. It psychologically will kill you because when you get older, you get more conservative. That's just the way it is.
And if it doesn't bother you guys, trust me, the women will bother you because they got that maternal thing going on, and it's very important to them.
So if you don't take anything from this case study today, think about whatever your bills are. Guarantee it. I talked to somebody just this week. I said, all right, you have saved enough money to retire. As long as you don't lose anything, you'll be golden. He was 80-something% stocks.
Oof.
I go, and I like stocks. I own stocks. I've been managing stocks for 30 years. I like stocks.
Yes, we have, and we do.
That's right. And so I said, well, right now it looks like you've won the race. You can guarantee your lifestyle till you die, unless you lose money. So my point is, if that's the case, and you've already won the race, why are you still running?
That's right.
This baby up. You're done. Retirement's done. Now, if you take a loss in your retirement account or your big brokerage account, you're fine. Because your lifestyle's covered till you die.
And most everyone's accounts out there, your 401ks, your retirement accounts, are probably higher today than they've ever been. Do you hear what I'm saying?
And a lot of times people don't realize is those 401ks, IRAs, you live long enough, they're not going to be that high because the government will force you to spend that down. So if they're going to force me to spend down some money, why don't I get an income stream that keeps paying even after that money's gone?
Yep.
And I'll have extra every month I could put to the non-qualified or non-pre-tax money. So my heirs get 30, 40% more inheritance because I didn't give them an IRA that has to be taxed at 40%. I gave them one that's already paid taxes. So either way, it's a win-win. It's a win-win for you. It's a win-win for your heirs. And even if you're a type of person like me, I said, kids, you're welcome to every dime I don't spend. Just hope I don't have to live with you. If you're that type too, I still want the peace of mind knowing I still got this account over here with all the money that I started with, or most of it, right? That kind of peace of mind is worth more than you could ever. I argue with accountants. Paying off your house, it's the last write-off. I go, the peace of mind knowing it's your house with no payments is worth way more than the tax write-off. Well, that's our show, folks. Remember, if you have any questions, like to take advantage of a retirement plan, don't hesitate to call us, 972-715-2424. Again, 972-715-2424. You can always go to ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.